let's assume I put my money in the S&P 500, I put $1 million in the S&P 500, and the S&P drops 25%. I'm down 25%, okay? Well, that's not fun, but now what if I did this? What if I took the interest from the Treasury, but I spent it today? I didn't spend it in a year. So I took that $46,000 and I put it in call options. Well, first of all, I would have no loss because in a year, my Treasury would go back to $1 million, but I would be able to capture 50% of the upside. So if the market's down 25, I'd be down nothing. If the market's up 25, I'd be up 12.5 because I'd capture half of the upside. All right, well, I think that's good, but I have no risk and I get 50% of the upside. Here's what's interesting. Remember, in 2009, we only captured 44% of the upside with a 60-40. So if I can capture 50% of the upside, because in 2008, I captured 50% of the downside. So if I can capture 50% of the upside with absolute no risk, that sounds too good to be true. All I'm doing is I'm saying, I'm using the 47,000. If the options expire worthless, I still get $1 million at the end of the year because that 900,000 and change of the Treasury will be charged to $1 million. Well, that's a no-brainer. Now, if you had 50% of the market with no downside risk at all, and every year you just built them, which you can get right now, you would have averaged 6.6%. The S&P returned 7.8. Here's what's really interesting. The bonds would have only done 4.8. But what's interesting is, Marlon, 6.6 is not 50% of the market. 6.6 is 84% of the market because I'm not experiencing losses. That's interesting. It's interesting. Wow.